Okay, so welcome everybody to today's presentation, and we'll be talking about investment avenues and the different kinds of investment that you can do in the market, and who want to start with the basics of investments. So we'll be just discussing what all are the different options that are available for investment. Now, before we start, we need to understand that the meaning of assets and liabilities. Now, I'm sure you all have heard these words, and most of the speakers, I guess, start with assets and liabilities only. Assets are investments that grow over time. So anything that you put your money in and its value increases or its value actually grows are assets. So it is an investment, it is an asset. Shares is an investment, shares is an asset. Deposits are assets. So when you say that you have a fixed deposit, it is an asset. All your investments are assets. Gold is an asset. So I'm sure you're clear about assets. Liabilities are expenses that depreciate with time. So these are when you're putting in your money in places where the value is actually coming down. For example, your home appliances, your televisions, your refrigerators, your smartphones. In fact, smartphone values fall 20 to 30% immediately once you buy them. So it is the perfect example of a depreciating liability. So it is always recommended that you put in your money in assets more rather than liability. Now I have prepared here a life chart. Now I just want to explain in short what this means. So I think I need to come back to the slide. Yeah. So here you see your income now. That means basically your incoming money, which takes care of all these things that are seen in red. Your daily expenses, your house, your car, holidays, children, everything to do with children, their education, their schooling, insurance, your policies, your mediclaim, your life insurance, your life upgrades, that you have to keep upgrading your life, buying a new house, buying a new car, buying new clothes, everything to do with upgrading your life. Then your health. Then last but not the least, retirement. So your retirement planning also has to be taken care of by the income. Right now, why we have I've put in investment here is it has to be income plus investment. So both of these have to take care of your. So these two blue things have to take care of all these red things. So you have to empower your investment in such a way that both your income and your investment can take care of all these things. Now, as I don't have to tell you that these are all the different avenues of investment. There's gold, real estate, fixed deposits, recurring deposits, shares, mutual funds, public provident fund. We'll be talking about them in short. Fixed income instruments. Now, fixed deposits are you're just putting in a lump sum of money and you're getting a fixed rate of interest. So that's fixed deposits. Recurring deposits is when you're putting in a fixed amount of money every month and you're getting a compounding interest on it on a monthly basis. So that's recurring deposits. There's public provident fund. Now again, you're putting in a fixed amount of money every year in the public provident fund. A post office monthly income scheme is a one-time investment scheme where you get a rate of interest around 7.1, I guess, is the rate of interest that you get. And this is one of the most popular schemes, especially with the senior citizens and long-term investors. national saving certificates, one-time investments, government bonds. We can get into this details of government bonds later on. The returns of government bonds are similar to the returns of a fixed deposit. Non-convertible debentures are also an interesting investment. We can talk about these in detail. They also can give you very good returns. Talking about real estate, now, no doubt it builds a lot of wealth over a period of time. And many times the rate of return in real estate can be much higher than the stock market and gold. And the one major benefit of real estate is you can get rental income also. But then there are some drawbacks. It requires a huge investment upfront, and not everybody has the capability or the capacity to invest huge amounts at one go. A lot of maintenance costs are involved. And the third point, this is a very important point, that the buyer has to be very well versed with the government formalities. So you have every day you have cases where somebody has been duped because he was not very well aware of government formalities and stamp duties and all that. And one more drawback of real estate is low liquidity. By liquidity, I mean whenever I'm buying land, I am not able to sell it fast. So even if value of land goes up and you see you want to sell it off, but then you are not able to do it many times because you don't have buyers available easily. So that is liquidity. So there is low liquidity. Coming to the stock market. Now, this is a favorite of most of the investors, and I believe that the stock market gives you the best returns in the long term. But then you need to understand a few things. It is dependent on factors like the economy. So the economy has to be strong, obviously, and whenever there are ups and downs in the economy, the stock market is affected. Liquidity again. So when you have foreign investors putting a lot of money in the stock market, then the stock market is going up. Government policies keep changing. If government policies are favorable for industries, stock market will move up. Stock market will move down if something goes wrong with the government policies. So stock market is dependent on many factors, but still it is most highly recommended for the long term. So it has been proved time and again that the stock market can give you a lot of wealth in the long term. But again, you need to have a lot of patience. And one more thing is you need the right timing to invest. So when you're putting in the money, when market is at a very high, when the index is at very high level, and selling in panic, and then still expecting to make money, then the stock market is not for you. So you need patience, you need the right timing to invest. And the biggest drawback I feel is that emergency withdrawals may not be possible, profitable. That means if you put in your money in the stock market and you want to withdraw that money in an emergency, but if the stock market is down at that time, you may not find it easier to get you will get the money definitely, but you will not get the money that you need. You may have to sell your money, your stocks at a loss and get. Okay, just a second. Okay, now I've just put in a chart of the Sensex here. Now I'll just give you an idea of how the Sensex has been growing in the last few years. Now, if you can see from 1991 to 2003, it has more or less not moved much. So it has moved sideways. It has not given you a lot of returns. And then suddenly here it started going up. Yes, with the strong policies of the government, and here it touched the peak. And this was 2008 when the Sensex was around 20,000. And then you had this scam, the Lehman Brothers scam, and it crashed. It fell to around here these levels at around 7,600. So it was a big fall, around 60% fall. So from here to here in 2008, and then it has been going up consistently. Now here you see the pre-COVID levels. This was when the Sensex was around 42,000, and as soon as that the COVID news came in, it fell here up to 20, close to 25,000. So again, a huge drop. So it was a very big drop. We all know that, very, very big drop. But if you look at the chart, a long-term chart, it doesn't look so big. So it doesn't look very big if you see a long-term chart here. So overall, you can see that the graph is going up consistently. So that shows how the Sensex returns have been fantastic in the last few years. Talking about gold, now it's always said that gold is a hedge against inflation. That means inflation keeps going up, your purchasing power keeps coming down, and gold grows with the inflation. So it's a hedge against inflation. And many times when the market is going down, it is gold which is going up. So a lot of people will prefer, when stocks are crashing, to put their money in gold. So gold, no doubt, has also been a long-term wealth creator. Now here I've just put in a chart of the difference in returns. Now, for example, let's say if you put your money in a fixed deposit, and assuming 1,000 rupee per month investment. So that means if you put your money 2,40,000 rupees of fixed deposit for 20 years, your total value will be 7,15,000. Similarly, a PPF with a 12,000 investment per year, that is 1,000 per month, will give you a return of 5,32,000. This is that value. A recurring deposit will give you this much value, 3,20,032. A SIP, a systematic investment plan in mutual fund, where you're putting in just 1,000 rupees per month, and I'm calculating a return of minimum 10%, because mutual funds give a minimum 10% return, is 7,66,000. So mutual fund returns are highest here. A lump sum mutual fund of 2,40,000 at 10% gives you 16,14,000. And the same thing compared at 12% is 23,15,000. So I mean, you can see the difference, just 2% difference, and a huge difference in the amount. Gold has, if you compare the last 20 years returns on gold, then it has given a 2,40,000 investment has given you a return of 10,75,800. So this is just to give you an idea of the different returns with the different kinds of avenues. That will help you to judge. Talking about mutual funds, yes, if you are not investing directly in the stock market, then mutual funds is a very good investment for you. Average rate of return is 10%. Even the worst mutual fund is giving a return of about 10%, and it can go up to 15% in the long term. Now again, talking of mutual funds, we have different kinds of mutual funds. You have pure equity. That means understanding mutual funds is basically they are taking money from the public and they are putting their money in the stock market, and whatever profits they are making, they are giving it back to the public. So that's mutual funds for somebody who is not very well aware of mutual funds. So mutual funds is either pure equity. That means by pure equity, you mean that they are putting most of their money in the stock market. Balanced is when they're putting part of the money in the stock market and part of the money in debt. Debt is government FDs and government bonds and the things that we had already discussed earlier. Mutual funds don't have an entry and exit load, but yes, these things should be considered that they have overheads. So you may not actually get, even if the mutual fund is making good money, it may not come down to you. You may not get very high profits because they have high overheads, and emergency withdrawals may not be possible. So again, the same thing with stock market. If you want to withdraw in an emergency, but if the market is down, you may not get the values that you want. So these are some of the drawbacks. Gold, as we've already spoken about gold, its last 20 years returns have been equal almost to the stock market and real estate. Yes, there are drawbacks of gold. You have to store it physically, so many times um, it gets difficult to you need lockers and you need good places to store. But though nowadays you can trade in gold funds, so that means you don't have to buy gold, actually buy gold, but you can buy gold units. And these units, they move at the same, like they, as per the gold rates. So, I mean, it's like buying gold in a, okay, coming back to, now I want to share this screen with you. This is just an example of just putting in 1,000 rupees per month, and here you can see the difference in the graph. Now this yellow chart will show you the amount of money returns that you can generate when you're putting your money in a recurring account, blue in an SIP, and the red one in a PPF. So this will indicate to you the difference of investments that, just a second. Now there's one more chart here. This will show you a difference between an FD, a mutual fund, and gold. So the yellow one will show you the FD chart, the blue is the mutual fund chart, and the red one is the gold chart. Okay, now this slide I have prepared to just tell you how important it is to start investing early. Now, if you put in 1,000 rupees per month, okay, so this small graph here, it will show you how much the amount of money that you are investing. And if you put in 1,000 rupees per month, your total investment in 38.5 years will be 4,62,000. Okay. And if you calculate your returns at 12%, the value is 1 crore. So you can imagine just 1,000 rupees per month for a period of, it looks 38.5 years is a lot of time, but 1,000 is a very small amount. At 12% returns is 1 crore. So you can see the difference here in the graph. So that's, I guess, is the end of the slideshow. And the last slide was basically to stress on the fact that it's very important to start investing early. So this was a very short duration. I didn't have enough time to share more details, and we can always discuss more details later on. Now, I'd just like, if anybody wants to ask any questions or anybody wants to share something, so you are free to do it. So any doubts or anything you want to ask? Anybody?
Ashish,
Yes,
may I just
Atul.
ask one question?
Yes, Atul.
Like my son is 24, right? So
Okay.
at this age, what should he invest in? Equity, debt, or what?
24, right? So at 24, I think he's quite young. So I think he can take some risks. So for
Acha.
his age, I think investing directly in the stock market is could be the right decision. I feel it is the right decision. It has to be a mix of everything. So you cannot don't put all your money in the stock market. Don't put all your money in, don't put all your eggs in one basket, as they say. So put some amount of money in the stock market. Definitely he has to be there. He should be there in the stock market. And
Okay.
yes, and if he doesn't have the time to study the stock market, and doesn't want to make the effort to study the stock market, then he can invest with equity mutual funds. So mutual funds will give him a very good return for some time, for many years. And then after, see, actually it has to keep changing. So he can start off with the stock market, and as his age grows, then he has to shift from reducing his equity and moving towards debt.
I would like to ask, thank you for your information.
Yeah.
I have heard a lot about dividend. Can you
Ah.
tell me what exactly it is?
Dividends is generally given by companies when you're putting in your money in in a company in the stock market, and the companies collect money from shareholders, and whatever profits they make, that profit is given back to the shareholders as dividend. So when you are having a share of a company, the company is giving you a dividend. That means it is sharing a part of their profit. That part of the profit is called as a dividend. And some people actually do a lot of dividend investing also. So a lot of people, they will just invest in the market only for dividends. So the higher, some companies will give you very good returns, only dividend returns. So that is also a very good investment. Is it clear?
Yes. Thank you so much. And one more.
Yeah.
According to you, which is the best investment?
Is it for you?
Yes.
Are you? Can you tell me what you are doing and what? Yeah.
I am a teacher, and so what investment should I do?
Okay. So I mean, see, it also depends on whether you can lock in your money for some time or not. It's basically,
Yes.
there is a rule in the stock market. There is a rule in investment, rather. You can say that whatever your age, you subtract your age by from 100. So suppose your age is 40, and you subtract 40 from 100. So that's 60. So 60 percent of your money should be in equity, that is stock market, and 40% should be in debt. And as your age keeps increasing, you keep reducing your investment in the stock market, and you keep increasing into debt. So it also depends on which phase of life you are in right now, and what do you want to do with the money in the future, and when you need your money. When do you need your money? That is also important. So when you put in your money and after a year you need the money, then it's not advisable to invest in the stock market, because uh, it's better you put in your money for a longer duration when you're putting it in the stock market. Clear?
Yes. Thank you.
Okay. Anything else? So I guess that's it. I hope you liked my presentation. And this was just beginning, and it was my first attempt. So I hope you like it.